Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel and want to hear more about personal finance, please subscribe. In this video, I'm going to be talking about the reality of some common investment myths or debunking them. Let's get started. There is a common perception that you need a lot of money to start investing. It's less of a myth and more of just an assumption. These days, with trade fees dropping and most online brokers bringing them down to zero, with some exceptions, it's possible to start investing with as little as $50 or $100. Also, the longer you wait to invest, the less likely you'll actually invest the money you save up, because you'll probably end up spending it instead, even if it wasn't intentional. The first myth I want to talk about is sell in May and go away. Some of you may have heard of it, and others may not have who have just started to invest. It's somewhere between a reality and a myth because there is actually quite a bit of data that makes it pretty balanced between a reality and a myth. So then what does the saying mean? It basically speaks to the underperformance of the stock market and investment returns during the summer months. Specifically May through September or May through October, depending on the set of data and charts you're looking at. The saying points to lower trading volume from May starting around Memorial Day through September and October, which is around Labor Day and Halloween, due to people going on vacation because of the warmer weather in the United States during that time. Less people buying typically translates to less growth in stock prices and investment returns. There are several decades of data and stock market patterns that support the theory behind this saying and strategy. This chart shows the impact of selling in May and buying back into the stock market in October versus just holding and not selling in May. So then should you sell in May and go away? Before I go into more detail, this myth really only applies to short-term investors and day traders. Anyone with a longer investment time horizon than about 1 year, this myth really wouldn't have much relevance for you at all. Based on data in the 6 months from May through October, the performance in the stock market has been worse when comparing it to the 6 months from November to April. This results in around 1% or less in improved returns when looking back at the past 30 years by selling in May and going away. But when you take into account the taxes involved by realizing any gains and exiting positions and then buying back in later, overall it doesn't substantially improve investment performance. The other point to note here is, how will you know when the right time is to both sell out of your positions in May and then also buy back in either in October or November? Also in 2020, which was an extremely abnormal year for the world and the stock market, the recovery rebound in the stock market happened starting in April through the summer months and even into fall. So even if decades of data points to this being a sort of viable theory, had you followed sell in May and go away, your portfolio would have missed the entire recovery rebound in 2020. There are only two reasons where it might make sense to consider a sell in May and go away strategy. The first reason is if you have some gains and want to lock in some of those profits for the current calendar year. Even then, that still would not be your entire portfolio, maybe just a few stocks or ETFs. The positions that you would consider selling and taking your profits on would be the ones that you don't want to be in for the long term or are heavily impacted by seasonality. The second reason is if you're just worried that the market will dip in the summer, as history points out, and you're happy to just sit in cash to avoid negative returns and actually buy on the dip when the market drops or has some kind of correction in the summer months. Keep in mind that there may not be a dip or correction in the stock market every summer just because the data points to that happening historically. If you decide to actually sell in May and go away, it could be a good idea after selling to have that cash sit on the sidelines for a bit until you see another investment or stock catch your attention. The summer months can sort of be a reminder and a good time to adjust your investment mix for any rebalancing. Some alternative options, rather than to sell and either partially or totally be out of the market during those months, are to consider sector rotation as part of rebalancing your portfolio or buy put options as a hedge. If you believe in this myth, May might be a good time to consider rebalancing your portfolio into different sectors that may be less affected by seasonality like technology or healthcare. By buying put options to hedge some or all of your positions during those months, if you felt concerned about stock market performance during the May to October time period, by purchasing a put option on stocks you already own, this gives you the right to potentially sell a stock at a specific price, known as the strike price, by a specific time. Each option contract applies to 100 shares. If an investor is able to exercise the purchased put option before the expiration date, they would be able to make a profit instead of holding a stock at a loss. If the put option expires worthless, then the stock price should have increased or stayed relatively flat. I don't think put options are the greatest idea for the most part. It's likely better to just buy and hold, but it is another option if you want to research that further for your investment portfolio. In summary, for this myth and theory, if you're a short-term investor, there are multiple options to consider, like rebalancing, taxes, sector rotation, and whether you want to figure out when the right time is to both sell in May and buy back into the market in either October or November. If you are a long-term investor with a buy and hold strategy, just stick to your original plan. You should make your investment decisions based on more important factors like fundamentals and growth potential for each stock position rather than sell in May and go away, and ignore the myth of sell in May and go away. The second myth is investing in the stock market is too risky. If you've been investing for a bit, you'll notice that when the stock market is down, it usually goes down faster than it goes up. Investors tend to have more extreme reactions to losses than to gains. The fear that investing money into the stock market could lead to losing money keeps many people out of the stock market for too long, and that will likely keep them from reaching their financial goals instead. Do not be afraid of investing because of this myth, along with not knowing what to invest in. If you're really not sure what to invest in, you can invest using a robo-advisor or simply invest in a low-cost ETF that tracks an index like SPY to get started. You can also learn more about investing from my videos on robo-advisors or how to invest with $1,000 or less to see the other ways you can get started on your investment journey. You can see here that the amount of time you're invested in the stock market plays a large part in mitigating most of the risk, even though past performance does not guarantee future results. Diversifying your portfolio into different sectors, indexes, and stocks can also balance out your portfolio by investing in different types of companies and industries which help with seasonality in terms of performance throughout any given calendar year. The third myth is that it's safer to keep your money in a savings account instead of investing. This is absolutely false. By keeping your money in a savings account instead of investing at least some of it, you're missing out on potential stock market returns that are significantly higher than the interest rate a savings account can offer. And if your savings interest rate is not equal to or higher than 3%, you're actually losing money without even realizing it by losing purchasing power. If you assume inflation is about 2 to 3% a year, at a minimum you need to be making at least that to maintain your buying power, even if you aren't trying to substantially increase your wealth. Who wants to be able to buy less than they did last year with their money just because they chose not to invest? That seems ridiculous to not chase those gains. Here is a chart that illustrates the difference between someone who is a strict saver but does not invest their money in the stock market and an investor who does. They both contribute the same $15,000 at the beginning of each year for 40 years, and the difference in amount accumulated at the end of the 40 years is over 3 times higher for the investor. The fourth myth is that I'm just waiting to get into the stock market at the right time, which almost always leads to never investing into the stock market and experiencing beginner's investment syndrome from not knowing what to invest in and then just simply not choosing to invest. Waiting for the best time to invest can lead to a lot of missed potential profits if you had only been invested earlier. The other thing is, if you're a beginner that is new to investing, you really can't tell when the best time is to jump into the stock market yet because you've had no experience investing. This chart shows all the missed profits by not being invested on some of the best days of the stock market over the past 40 years, assuming an investment of $10,000. An alternative to jumping right into the stock market is to go with dollar cost averaging and investing a set dollar amount slowly over time to ease your way in and be consistent with your saving and investing. A 2012 study from Vanguard shows that investing in a lump sum provides better performance due to having more money invested in the stock market sooner, and that dollar cost averaging just defers risk into the future. The study was done in 3 different markets: the United States, the United Kingdom, and Australia, where the results were similar over different time periods. I'll put the link to the study in the description if you want to check that out. The fifth myth is that investing in stocks is similar to gambling. This is simply not true. Investing is not like gambling. Gambling is a zero-sum game where the party that loses gives money to the winner. Investing is not a zero-sum game. There are no clear winners and losers. When investing in a stock by purchasing shares of a company, the share price is a representation of value, and that value is based on the company's assets and balance sheet, along with future earnings potential. By investing in a company, wealth of the economy increases as the company innovates and develops products or services while making a profit. That profit and profit potential is represented in the share price when being evaluated by investors, which is why the stock price of companies constantly fluctuates as investors buy and sell in or out of a stock. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.